My name is Taylor Casey and I am joined by Nick Griffin, James Findus and Qiao Ma. We are going to be talking to you about the funds over the last 12 months, but ultimately we want to give the information that you want to hear. So please make sure you submit your questions to the Q&A box and we will make sure that we get them answered. Before we kick off, I have to read a quick disclaimer, which is a quick reminder that everything we cover in this update is general information only and is not intended to be financial advice. The views held by Munro partners are current at the time of this live stream and are subject to change. Okay, now that we have all of that out of the way, let's get into what everybody wants to know. So Nick, starting with you, I think a good place to start would be a business update. Can you remind everyone what Munro is trying to achieve and how do you go about doing it?
Yeah, look, thanks very much, Taylor, and thanks very much everyone for dialing in and trying this new concept with us. I understand there's lots of direct investors on the call and potentially some new investors on the call, so we'll keep a very high level introduction just to begin with. And so look, the first thing to point out is look, we're here to talk about global equities. Munro Partners is a global equity manager. We do global equity and we do growth. So we're permanently a bit glass half full. We're permanently trying to look about what's possible in the world today. We have roughly 30 people here in Melbourne, Australia, and we run roughly $7.5 billion in assets under management. There's four main products that we're going to be talking to you about today, and I'm joined by my colleagues here, James and Qiao. And so the four main products we're showing you here on this slide, if you can see, and what we're trying to show on this slide, if you look along the bottom, you'll see there's a risk curve, a risk or a beta is what we call it. On the y-axis is a return. And so all of our funds, we're attempting to achieve more than 10% per annum returns after all fees and expenses over the investment cycle. We have the Munro Global Growth Fund, which is also done by the ticker code MAET as the ETF. And this is an absolute return fund. So this is our best global growth ideas, but with downside protection, you know, the ability to protect through the cycle. And it's really there to smooth the ride for our clients. We have the Munro Concentrated Global Growth Fund, which is essentially the same fund, but fully invested. And so if you're, you know, potentially, if you can put up with more volatility, this is ultimately going to give you a better return over the long-term horizon, but a slightly higher volatility. And then we also have the Munro Climate Leaders Fund, which is our investor in the fund that invests in the enablers of decarbonisation that James looks after with myself here. And again, taking a little bit more risk, but a little bit more return. And then lastly, we have the Munro Small and Mid-Cap Fund, which is run by Qiao Ma. Similar sort of level of risk and similar sort of level of return. And so what are we trying to achieve? I'm actually going to finally answer your question now, Taylor. What are we actually trying to achieve here? Look, we're going to be talking about this a lot today. And so we try to keep this really simple at Munro. The simple story is that earnings growth drives stock prices. So what we're trying to do, ladies and gentlemen, is we're trying to find companies that are going to grow their earnings over time. And if they grow their earnings over their time, their share price normally grows. We show these same two companies all the time. One's MasterCard, one's Bank of America. And on this slide, I'm showing you their earnings growth over time, and their share price is ultimately just following their earnings growth. That's how the share market works. MasterCard, we think, is a structurally growing company. It benefits from the shift from physical to digital cash, whereas Bank of America is a cyclical growing company. It relies on interest rates, it relies on the economy, it relies on a whole bunch of things. So in our webinars or our live streams, you know, they're a little bit different. We're always talking about these big structural changes and talking a lot less about the economy, because that's ultimately what we're looking for. We're trying to find this MasterCard situation over and over again. And so what you're going to hear us talk about a lot today, and please do ask this in your questions, is what we try to do is we shrink our universe down to these smaller, structurally growing companies, as you can see on the slide up here. And this smaller universe of 1,000 companies, they all sit in these different areas of interest, and they're all basically sitting along this S-curve. You can't structurally grow unless you're taking share from someone else. So we talk about digital payments, they're probably near the end or closer to the end of the S-curve. We talk about e-commerce, it's about halfway through. We're going to talk about high-performance computing and AI. We think it's closer to the start. Lots of other people are going to think it's closer to the end. But all we're trying to do here really across all of our funds is identify these areas of structural growth. That structural growth will give us earnings growth, and that earnings growth will give us share price growth. And that's all effectively sitting somewhere on these S-curves. So that's what we do, that's how we do it. And I'm sure we're going to be talking a lot about this today, but that's a very short introduction.
Yes, we are going to be talking a lot about that. But I guess for any of our investors who have been following along, they might remember that this time last year, you said after a strong 23 and 24 that 2025 was going to be the third year of the bull market. We're nearly all the way through 2025. Has that played out?
Yeah, so within what we're doing around structural growth earnings companies, so the world is changing and you have these structural changes, you have effectively market cycles. A market cycle is where things get, very expensive and then they get very cheap. And so we have bull markets and bear markets. We had our last bear market in 2022. The NASDAQ fell nearly 33% that year. Your average stock fell 50%. Our funds fell that year. They did. But that bear market has cleaned out all the excessive risk taking. And so you're now in a bull market. And bull markets generally last somewhere between 3 and 10 years. This one, the first 2 years are always the best, and that's what happened in this case. So 2023 and 24 were very strong years for markets, and all of our funds did more than 20% plus in those periods. As you go into year three is normally a bit of a volatile year. And I think we said at the start of the year, it would be a volatile year, but you could still expect solid double-digit returns out of markets, and we expected solid double-digit returns from our funds. And that's essentially what happened. We've had a very volatile year. We've had like DeepSeek, we've had Liberation Day, we've had this more recent correction here in November. But ultimately, S&P's up 15% for the year, and all of our funds are delivering solid double-digit returns. So ultimately playing out how we thought it would.
So with that backdrop, maybe we can talk about performance over the last 12 months. We're not at the end of November yet, so looking up until October 31, can you tell us about the performance of the funds?
Yeah, so pleasingly, from our point of view, we, having set the task for the year, having had very strong years last year, and a lot of our funds were up, 30, 40% plus last year. A lot of people were like, well, surely you can't do that again in 2025. And we said, no, the framework is markets should give you double-digit returns. And pleasingly, we've managed to position to achieve that as well. What we're showing you on this slide is the numbers over the last 1 year rolling. So it's going back to October last year. And so these numbers are a little bit high versus what we are for the calendar year. But I can pleasantly point out for the calendar year, even with November, every single one of our funds is doing more than double-digit returns, and some are doing more than 20% returns year to date. And pleasingly, should the year finish out in December with a little less drama, we should ultimately achieve our targets here for the year. So from our point of view, very happy with the performance of the funds over the last 12 months and how they've positioned. And obviously, I'm very much focused on the first two here, being the absolute return fund, the Munro Global Growth Fund, and the Munro Concentratable Growth Fund. And I'll let James and Qiao talk about the other two.
Exactly. So maybe with that, Qiao, could you tell us about the Munro Global Growth Small and Mid Cap? Has it been a similar story?
Yeah, it has. We are the new kid on the block. So we started a small mid-cap fund just over 2 years ago. And pleasingly, we've doubled the money for our investors since we started the fund. And on a rolling 12-month basis, we're up about 36%. And so a strong start. But really what got us excited, and we'll talk a lot about it, is we think 2026 is set up to be a really favorable year for the smaller end of the market again.
And James, can you tell us about the Munro Climate Change Leaders Fund?
Yeah, sure. Well, thank you. Climate Change Leaders had a good year as well. It's up sort of 30% rolling, which has been good given we've had obviously election in the US and a lot of worries around, Trump's rhetoric around green investments and so forth. But at the end of the day, the companies are all still delivering. Decarbonisation agenda is a structural growth thematic that's going to last a lot longer than the presidential cycle. And you're starting to see that growth come through from the decarbonisation spending, and that's helping the earnings of the companies that we invest in, and therefore the share prices are going up as well, so the fund's going up.
Wonderful. Qiao, I'd love to come back to you, and I was just wondering if you could remind our audience why we set up a small and mid-cap fund in 23. It's just crossed 2 years old.
Yeah, so we just rewind the clock back to 2 years ago. We started the fund really for two really simple reasons. The one, which is the most important reason for us, is a lot of these areas of interest that Nick just talked about. When you just think about the adoption of these really large technology and different trends in different industries is an S-curve. We're just seeing a lot of opportunities at the earlier part of the S-curve. And the biggest reason for that is something structurally is really changing in these large areas of interest. And we say, wow, the industry is changing, a whole group of smaller winners are emerging, and this is a really interesting time to really go capture these smaller winners. we sit at a pretty advantageous position as Munro, since we've done work in these areas of interest for over 10 years. We've had the network, we've had the domain expertise, and we said, well, we don't have to make things very complicated. We're just going inside our own areas of interest, go down the S-curve and find these smaller winners. I think one of the big advantage also is, and that was the case 2 years ago, that remained the case today, is nobody's looking at these smaller companies. So we can see their earnings are growing really strong. They're taking all the boxes that we have internally for really high quality growth companies. But really, when you're thinking about the attention of the broader investor base or the broader Wall Street community, on average, we love our holdings in Munro Global Growth, but there will be 30 analysts looking at them versus the smaller mid-cap companies benefiting from the same similar trends. And on average, it'll be 2 to 5 analysts looking at them at all. So we tend to find a lot of bargains in terms of valuation for the earning growth that you're getting. And we're also getting a lot of these asymmetric upsides. And the last thing I would say is, because the opportunity set has been so rich, that we really don't have to lower our standard in any way. So every company we hold in the small mid-cap company in the fund is profitable, generate positive free cash flow, really tick all the boxes of what we're looking for at Munro.
And it uses the same investment team as well. It uses everybody.
It uses everybody. So I sit at this luxurious position running a small mid-cap portfolio, but we really tap into the domain expertise of all 12 investment professionals that we have.
Wonderful. So Nick, you sort of flirted it with in the intro, but we want to come back and actually answer it. There's been a lot of talk about whether or not AI is in a bubble. What are your thoughts?
Yeah, so the bubble question, we've been getting it a bit lately.
I bet.
Okay, so as we talked about, we're trying to invest in big structural changes, and to be clear, a lot of the returns we are generating over the last couple of years have definitely been coming from some of these AI investments. We've identified this structural change early and identified some of the winners here, companies like NVIDIA and also on the power side. So maybe let's just deal with the bubble question straight off the bat. So when I hear the word bubble, I hear valuation bubble. That was the last bubble in 1999. And that's a valuation bubble. And just to give you an idea, I was there. The NASDAQ actually went up more than 90% that year, okay? The NASDAQ's up less than 20% this year, okay? So it doesn't feel like we're in a bubble, if that makes sense. And on top of that, most of the companies traded at 99 or 100 times earnings. The biggest companies in the S&P today, like Google or NVIDIA or Amazon, they all trade at sort of mid-20s PEs. So it doesn't feel like we're in a valuation bubble. I think what people are actually referring to are we actually in an AI spending bubble. And there's definitely things we need to question. And so maybe it's a good time to go back and just remind people of what the thesis is around AI and why we don't think we're actually in a spending bubble. So what I'm going to show you here is a slide. It's actually a slide that we built more than a couple of years ago at Munro. And so anyone who's dialed into a webinar has heard me talk about this before. You should think about AI as very much like the smartphone cycle. When the smartphone came along, it was millions and millions of apps on your phone that actually made it work. So apps like Uber and Spotify, or apps like Facebook and Google, or apps like Qantas that helped you check in for a plane, or helped you bank online. And all of those apps basically drove Apple to being the biggest company in the world because the device was so useful. AI is going to be very similar. We're seeing basically thousands and thousands of apps being developed using AI technology, either for programming or things like ChatGPT or things like Gemini, or people are using it in predictive maintenance, et cetera, et cetera. And so all of these apps have to run through these big models that you've heard about, and all of that needs to run on the cloud. And so what we've been seeing in the last couple of years is cloud demand has accelerated. Azure's grown to like 40%. Amazon's into the mid-20s. Oracle's appeared as a cloud provider, and all of these cloud providers are having to buy more and more semiconductors, okay? So the important thing to remember here is these people are spending all this money because they're getting the demand signals from all of these applications that are using AI. And I think the big risk a couple of years ago when we built this slide is is everyone actually going to use this stuff? Well, we now know that everyone is using this stuff. So the simple way to think about this is demand is basically exceeding supply. And so what's happening here is these companies are spending, they're building out data center capex, they're building out effectively AI factories, as people like to call them, that process tokens, that process all these AI queries. Assuming we get more and more AI queries, they're going to have to build out more and more capacity. And they are getting a return on that capacity because the people are paying for the use of that product. And so from our point of view, we're only really 2 or 3 years into this. We're 2 years into this. And ultimately, the use cases of AI are going to proliferate dramatically. continue to proliferate dramatically from here. And as the AI models get better, like Gemini drops, when Gemini 3 drops and it's better than Gemini 2, that creates more use cases. So you actually need more compute today than you needed 3 weeks ago because these models have got better. So from our point of view, demand exceeds supply, the spending will continue, and our job is to position the funds to benefit from that spending. Put simply, if companies are going to spend trillions of dollars building out AI infrastructure, our job is to invest in the companies that enable that construction, because that's trillions of revenue for those companies. And so that's how we've been positioning for the last couple of years, and that's how we continue to position into the future. So we still like NVIDIA here. We still like the semiconductor supply chain. Qiao's done a lot of great work around networking and around some of the smaller cap winners here. And on the power side, we are still investing on the power side because we're going to need a lot of power to drive this. And so the simple answer to your question, and I've answered it incredibly longly again, Taylor,
okay.
I'm the bad one in this. I'm the bad one in this webinar.
People want to hear what you think.
The simple answer to your question is this is a boom, not a bubble, okay? It's a boom that we're sort of 2 or 3 years into, and people should not be afraid of it. We've all been through booms before. Australia had the super cycle. It went for 10 years as China built up their infrastructure. That created all these great companies that benefited from it. We're seeing exactly the same thing here. The boom is just different. The boom is building data centers to host all these amazing AI applications. And as we go forward, the fun bit's going to be trying to work out what are all these applications going to be able to do, and can we invest in them?
And so while we are very excited by AI, we do run diversified portfolios. Can you maybe tell us some of the other areas of interest that have done well?
Yeah, so from our point of view, everything I just talked about makes up roughly 40% of the all-cap strategies. So the Munro Global Growth Fund and the Munro Concentrated Global Growth Fund. We have about 60% of the fund invested elsewhere in other structural growth trends, be it live sports, be it healthcare, be it defense spending, etc. The picture we're trying to create for our clients is the one I'm going to show you here. This is just a good backwards looking of what we're trying to do. And obviously we've had a good year and we're talking about that. And so this is what good looks like. And this is what we try to produce every year. And so on the left-hand side, I'm just showing you the 1-year attribution for the Munro Concentrated Global Growth Fund, so our long-only product, but the absolute return product is the same. And on the left-hand side, you can see the areas of interest where we got basis points return. So all the returns I just showed you over the last 12 months. And you can see it's quite diversified across these different areas. High performance compute AI is there, but you also have things like climate. You also have things like security and defense. And on the right-hand side, we're showing you the top 10 winners over the last 18 months. Sorry, over the last 12 months. And obviously NVIDIA's on top, but number 2 is Rheinmetall, a German defense company. You'll also things like CCEL, like CATL, which does batteries. You'll also see things like Galderma, that is the world leader in fillers, effectively, and dermatology. And so from our point of view, our job is to find these different areas of idiosyncratic structural growth and these different winners. AI is just one of them. It's one that everyone's talking about. But the good news is we have lots of other ones that we're looking at that we like as well, that will ultimately drive us towards the diversified returns that our clients are looking for.
So James, turning to you, what worked well for the climate fund this year?
Yeah, thanks, Taylor. This year and for the last couple of years, actually, it's really been around the clean energy transition and also around energy efficiency. So clean energy, if you just sort of think about it, zoom out, it's basically 20 years of underinvestment in the grid in the US. And all of a sudden, because of data center demand, EV demand, demand for heat pumps in your house and office, and also the reshoring of heavy industry to the US, that's creating a lot of stress on the grid, and a lot of the clean energy companies basically assist with that by not only building new solar and wind and things like that, which is like the obvious clean energy trade, but also building the grid and also building or extending the life of nuclear. And to be honest, our fund has been positioned in the latter two. So the guys that build the grid and the guys that are benefiting from this sort of extension of the nuclear plant life cycles. So we've been able to sort of profit from those areas quite nicely over the last sort of 12, 24 months. Second big area for us has been the energy efficiency side. And so if you think about this building, Munro is a net zero signatory. So we've got to reduce our carbon footprint like most other businesses out there. And so what do? We decarbonise our premises as the first thing you do. And so that's companies involved with the better running of these offices or plants or retail stores or whatever it is. So if you think about it, it's heating, ventilation, air conditioning, it's lighting, it's insulation. And so that's been good for us as well. Clean transport shows up here on the slide as a positive contributor, but we don't like EVs. EV market's very tough, very competitive. Great from a consumer perspective. You can buy a great new BYD or something like that at a good price point, but not good for the companies that have to compete with BYD. And so not a good place to invest from our perspective. We own the companies, not the cars. And so that's really one company specifically, being Cattle, which is a battery company, which Nick just referenced. Last area, which has been a slight detractor, has been the circular economy. We really like that area. It's waste, recycling, water treatment, etc. But it's just a bit of a tougher area over the last little period of time because the cycle's been a bit rough in the macro. So yeah, pleasingly a good spread though of different names. So at the top, we've obviously got some of these power generation companies and the grid companies. As I mentioned, Cattle's been good as well. A bit of a 1 in a million company there. And then beyond that, it's really simple stories like the guys that basically build the grid and install the HVAC, companies like Comfort Systems and Quanta Services. So yeah, decent spread.
So both you and Nick have mentioned a stock, which is CATL or Cattle. Can you tell us a little bit more about it?
Yeah, sure. Well, as I say, we haven't really liked this sector or the EV sector for the last few years. We've obviously looked very closely at Tesla and BYD and a lot of the other companies in this space, but it hasn't been a great place to invest. Cattle is a recent IPO in Hong Kong, but the company actually has been listed in China on A-shares or onshore for a long period of time. So we have followed this stock for a while. And the Hong Kong listing allowed us to get involved with the company for the climate fund. And so the beauty of this company is, and its industry, is that the battery industry or the suppliers to the EVs is a lot more consolidated than the actual car companies themselves. So there's about a half a dozen companies involved here, and this one is really taking a lot of share. And so for that reason, it's been able to basically grow its earnings. And so that we're attracted to that earnings growth. And we think this industry will continue to grow at more than 20% per annum for the next 5 years because of that EV growth. They just play into that. But also beyond that, other applications as well. So when you think about solar and wind, they're great for the environment, but they're not on all the time. They have a pretty low capacity factor. So when you're placing coal and gas, you basically need to pair that solar and wind with batteries. So Cattle has a really big opportunity there as well in what they call the ESS market or the storage market for power generation.
I'm going to do a little bit of a shameless plug here, but for anyone who wants to learn more, Nick, you and I, we did do a podcast on this for our climate mini-series. So yes, for anyone who wants to learn more, please listen to our podcast. Qiao, turning to you, can you maybe tell us what worked well, what areas of interest worked well for the Munro Global Growth Small and Mid Cap Fund?
Yeah, so similar to what Nick and James talk about, there's a real spread here. So there's about 4 or 5 really large areas of interest like security, like high performance computing, like digital media really contribute significantly to performance over the past 12 months. One of the things we're quite proud of is we found quite a number of multi-baggers in terms of stock returns since we started the fund. But what really makes us happy is we actually found them across a very different range of areas of interest. So we've had multi-baggers in digital media and content, in app loving, in Reddit. We've found stocks that go up multiple times in high performance computing and connectivity in Astera Labs or Celestica. And then we even found stocks that go up multiple folds in infrastructure in Comfort Systems. So that's something that's been really pleasing, but again, is across a pretty wide range of areas of interest. From a stock story perspective, is similar. You have really top performing stocks coming from different areas of interest. And I would say probably for most of the investors out there, these companies are not really well known. And I think we were able to find them because, we follow that Munro process. We are in the Munro areas of interest. So to us, it was actually pretty obvious. We've known these companies for a long time. But again, these are not really well-known, well-covered companies. And a lot of times we actually pick them up at a bargain.
That's awesome. And so for people who spend a lot of time on the internet like me, they might recognize a logo there, which is Reddit.
Yeah.
Can you tell us the investment thesis around Reddit?
Yeah, absolutely. So Reddit, for those of you who are lovers of Reddit like myself, it's actually been around for about 25 years and is the largest user-generated content and discussion. So we call it the largest human conversation on the internet. So whatever questions you have, like how does my dishwasher work, to how do I discipline my 10-year-old, good luck with that, by the way, you can go on Reddit and have a discussion, and there'll be a forum moderated by other users. So Reddit as a public company only was listed roughly about 18 months ago. And when it first got listed, it was a hot IPO stock, and everybody remember how the Wall Street Best Group used Reddit to have a discussion. So this was really labeled as a roaring kitty stock and almost a retail stock favorite. But we actually started to do the digging on Reddit after all the IPO haze, all this hype passed, and the stock actually come crashing down once the IPO investors move on. And what we realized is, and we have the team here that has been looking at Meta, Google, Amazon for the past 10 years, and we're like, that's actually nothing strange about this. This is a really classic internet platform that was growing users, that is growing content, that is attracting advertisers and revenue. And then we layer on our understanding of AI. So we got to see how AI completely supercharged the revenue growth for Facebook. And we look at Reddit and say, wow, they're actually doing the exact same playbook. They're using AI to understand the existing content on the platform much better. They end up generating better insights for advertisers. They end up translating the entire corpus of 25 years of English conversations into different languages using AI. And all of a sudden, you become really useful for people who speak French or who speak Italian. So we start seeing all these things happening. And then the best thing is, when we bought Reddit, this company was growing 60% revenue, doubling in profit. And we end up paying about 20 times price to earnings for a stock, which is just an absolute bargain. And even after we probably more than triple our money in Reddit, even today, because the profit has grown so much, you can still buy Reddit at roughly 33 times PE for a stock that is still growing at 50, 60%, which we still think is quite attractive.
It sounds awesome. So Nick, turning to you, I'm wanting to make sure that we get through our questions so we can get to our audience questions. But very quickly, I'm just wondering, so the Munro Global Growth Fund and MAET are part of our long-short strategy, and you do have additional levers to help with managing volatility. What does that look like today?
Yeah, so today, probably the best way to describe it is to show this slide that we use internally and we use in our materials. And so what we're showing on this slide is, it's important to remember that, as you point out, the Munro Global Growth Fund, or MAT, is what we'd call a variable beta fund or an absolute return fund. So we do have the ability to hold cash. We do have the ability to short sell. What this slide shows you is the orange line is the key one. That's the net exposure of the fund over time. And you can see that we can drop the exposure and lift it again. Many times you'll see the exposure dropping dramatically quite quickly, and that's us not selling the whole fund and buying it back. That's just because we bought a put option and the market happened to fall quite a lot, and that protected the fund and basically gave us synthetic low exposure. You'll see that most noticeably in COVID, where we did own put options, and that worked out quite well. You'll also see us lower exposure there through 2022, which was the bear market I talked about at the start. Right now, we think we're in a bull market, as we talked about. We think we're going into year 4 of a bull market, which I'm sure we're about to talk about. And so we want to be reasonably fully invested. So fund exposure is very high. And you can see that these little drawdowns are happening, and that's us. That's put options going off over things like Liberation Day. That's put options going off like we've just happened here in November. And so that's us protecting against little corrections. And so from our point of view, we're using put options as a safety net underneath the fund exposure, which is actually quite high. And the reason why we do that is because it is an absolute return fund. We do need to protect the downside. We're obviously going to talk about a lot of things we can see here, but often it's the things you don't see coming that catch you out, like COVID, for instance. And so these put options come in very handy. And this is why this product is, as I said, very suitable for people who want to invest in growth equities, but want a bit of downside protection. And so that's the best way to think about how we're managing that fund today.
Sure. And Qiao, I just want to sneak in one more question before we go to audience questions. And that is, as we head into the end of the year, how are you feeling about valuations for small and mid-cap stocks?
Yeah, and sort of we talk about valuation a lot, and obviously sort of we understand as a market is getting a bit expensive. But in small and mid-cap, we actually still see a lot of bargains. So in certain areas of interest, like security, like high-performance computing, we do see valuation gaps start to close quite quickly between the smaller cap and the larger cap companies. But there are also like huge areas of interest, like innovative consumer, innovative finance, digital enterprise, the smaller SaaS companies, like the valuation level is all at decade lows. So we actually see a lot of opportunities into 26, especially as we start to think about interest rates start to fall, broader economies start to recover, M&A activities coming back to the market, and some of these industry deregulation, they all tend to benefit really the smaller end of the market. So we still see a lot of compelling opportunities.
Wonderful. Nikki, happy if we jump into questions?
I assume you've got a lot to add.
Yes, I certainly do. So the first question we wanted to ask is going back to June 30. So some people might not realise or might not fully understand distributions. Can you maybe talk us through it?
Yeah, so this is a little pet topic I definitely wanted to cover. And worth going on the slide. So obviously there's a lot of direct investors on the call today. So people who buy MAET directly as an ETF. And as an ETF, it has a share price, right? And so they follow the share price. And every June, because we are a unit trust, we have to pay out our distributions. We have to pay out our realised gains. So it can be taxed in your environment, not taxed in the fund, because everyone's tax environment is different. This last year, as you can see on this chart, we had a particularly big distribution. We had a big distribution because we'd had very strong returns over the last 2 years. And importantly, we had crystallised a lot of those strong gains coming into things like Liberation Day, for instance, et cetera, et cetera. And so we'd crystallised particularly a lot of NVIDIA through this period. And that caused a very large distribution. Some of our funds actually had nearly an 18% distribution. Some of them had a 15% distribution. And the share price went down 18% on the day. And my phone rang off the hook from all these people who invest in the fund saying, why is your fund down 18% today? And the important point is that this is just money going back into your bank account, us distributing our realised gains. Should you choose to reinvest your distributions, and that's something that I do, but obviously that's up to your own personal circumstances, then your returns are actually not the share price, your returns are actually this yellow line that we're showing on the slide here. And this will continue to happen because we'll continue to bank winners as we go along. We will continue to crystallise gains that will ultimately get paid out to you as a distribution every year. Probably not as big as the one we had last year. It was a bit of a one-off, but we'd had a very, very strong period. But it's definitely something clients should get used to and hopefully understand a bit better now.
Yep, perfect. So James, turning to you, I'm actually surprised he hasn't made more of a feature in this, but I wanted to ask you about Trump. And so from a US political perspective, how does Trump set up for 2026 for climate-related stocks?
Yeah, I mean, we obviously have had a lot of incoming around Trump, and I'd just say, like, we are an active fund manager, so the Trump risk is not a new one to us. We have been investing in these climate funds these climate stocks for well over a decade. So we're sort of used to the political sort of cycles here. Obviously, coming out of 2023, we knew 2024 was an election year, and so we positioned the fund deliberately in bipartisan areas of support. So I mentioned earlier, sort of not having solar and wind exposure, but actually having grid exposure and nuclear exposure, because we knew that both parties were going to be behind that build out of the grid, the strengthening of the grid, the infrastructure, and both parties were going to support nuclear. So that's just an example of, or a small example of how we can actively tilt the fund, because we are an active fund manager. I just sort of commend the team, the analyst team, for sort of finding us those stocks, because that's really helped our performance dramatically and sort of carried us through this sort of Trump rhetoric around the renewables in particular. The only other thing I'd say, and to answer your question about 2026, it probably doesn't matter because Trump's now actually repealed the Biden era renewables programs, and he's actually put his own programs in. And so that's actually given certainty to the renewables industry. And on one hand, he sort of says it's a green news scam, and then on the other side, he's actually given you some more tax credits because he's at the end of the day pro-business. So he's given these guys less generous tax credits than before under Biden, but they're still pretty generous relative to the history of US policy support. So I actually don't think the election matters that much for next year for climate. And definitely not for us, because we can adjust anyway.
Sticking with the US economy, one of the questions that has come through, and please excuse my pronunciation, but for Nick, this question is for you. Torsten Slock, who's the chief economist at Apollo, is very positive on the US, as you might expect, because of easy financial conditions, which he wrote in his email. What are your thoughts?
Yeah, so we would agree. So coming to the point where third year was always going to be a tough one, and it has been tough, but ultimately come through. As we go into year four, a lot of these headwinds are in the rear vision mirror now. So there's probably two reasons why we think the US economy will be better, or actually three reasons why we think the US economy will be better next year. Look, the first reason, I'll just elaborate on what James said, is Trump. You know, and as we show on this picture here, if you want to look at the picture, but we actually think Trump is net positive equity markets. So there's good Trump and bad Trump. Everyone's got an opinion. I'm not going to wade in on that. But from an economic perspective, you know, bad Trump is clearly tariffs. I'm not going to sit here and say tariffs are a good thing for the market. We got that first, if that makes sense. Good Trump is things like depreciation allowances for capital spending. Good Trump is things like tax cuts. Good Trump is things like deregulation. Good Trump is things like M&A. And so we're moving into, we think, the good Trump period, and particularly that M&A and deregulation is really going to accelerate the growth of the US economy. The second reason, which again is what Torsten's flagged, and I read his stuff too, I think it's very good, is, you know, the rate cuts are actually in front of us. So a lot of the rate cuts we thought we were going to get this year, we didn't actually get. So the economy wasn't a supporter of equity markets this year. Most of our returns came from the structural areas that we managed to find and some of those AI stocks I talked about. But the economy didn't help at all. Qiao talked about this, you know, the consumer sector's on its knees. Different parts of finance sectors are not doing well either. And so as rates come down, they should start to contribute. They should start to get earnings growth, and that earnings growth, as we talked about at the start, will get share price growth. And so that's the second thing to be positive about. And the third thing to be positive about is just AI. So I know people are scared about AI, but we think the AI spending continues. And a lot of this just falls to the biggest companies in the United States. So because everything has to be run on the cloud to get AI to work, that really only goes to 4 companies. And all those cloud providers have to buy from these chip companies, and again, they're big companies in the US. And so if you think about that with this structure favoring the biggest companies, you can look at S&P earnings growth next year for the whole S&P 500 is going to be 15%, potentially 15% plus. So going back to what I said at the start, you know, stocks follow earnings, so do markets. If the market earnings growth grows 15% and the multiple stays the same, then we should be looking at a 15% return next year. Now, that's obviously a forecast, but there's plenty of reasons to feel that the US economy will be better next year than it was this year, because it actually wasn't that good this year.
Interesting. You did mention M&A, and Qiao, our next question is for you about M&A. So it says, Qiao, regarding company takeovers within small and mid caps, how has that played out in the fund, and what are your thoughts on M&A for 2026?
Yeah, I'm going to steal a line from Nick. That's still ahead of us. So we've actually have not had a single company that got taken out, period, since we started the fund, which sort of surprised us, to be honest. And none of the portfolio holdings were counting on a deal that's not in our model, that's not in our expectation. But if you just think about, you know, where we invest in this huge market, and these smaller companies growing really fast. In a lot of ways, you know, they're cheap relative to the growth they could offer. And their larger counterparts are biggest companies in the world sitting on lots of cash. So if you're a CFO, one of these larger companies, it makes a lot of sense to acquire some of these smaller, fast-growing companies. So we are excited about M&A for next year. And all the investment banks that we've been having conversations are telling us the pipeline for M&A and IPO are just incredibly active. Coming down 2026 is something to look forward to, but that's not our base case.
I might jump in there as well and just add one thing. Another thing you've got to think about with M&A here is you've got 3 years left of the Trump presidency. You don't know whether the next president's going to let this through, but Trump is very much about national champions. He's not about trying to kneecap his biggest companies. He's trying to help them beat their Chinese competitors. And so I suspect they'll be more liberal, or what's the right word? They'll be more easy on M&A transactions, and I think corporate America knows that. So they've got the clock is ticking if they want to get it done.
Understood. Someone has also asked, can you please explain the 4-step Munro process, and in particular the characteristic score?
Oh God. Okay. It's a good question. I'll give you the short version. So remember at the start, identify structurally growing companies along an S-curve. So we have a structural growing universe of roughly 1,000 companies. Obviously, if you find these companies, you find these areas, you might not find the right company. So we could have thought smartphones are going to be big, and we could still own our BlackBerry shares today. And that would not be good. I still have my BlackBerry, by the way, but I don't use it anymore. So there's 6 great qualities to a great growth company, which I'm showing here on the slide, which is growth, earnings leverage, durability, ESG, controlling shareholders, and an amazing customer perception. And so that exact score is how we score each company. Generally, the companies that score highest on these 6 measures win. So if you think about it, Apple had them, BlackBerry didn't, Google had them, Yahoo didn't, Amazon had them, eBay didn't. And so these 6, NVIDIA has them, Intel doesn't. So from that point of view, these are the 6 qualities. The higher you score, the higher multiple we can pay. But ultimately, we build a bottom-up model on every company. These big screens behind me are the exact screens where we show these bottom-up models internally. We produce earnings forecasts. And so we set a 5-year price target. That's a 5-year earnings target times the multiple we think it should trade at. And we want the company to double, to go up more than 100% within the next 5 years, mathematically. Because ultimately, remember what I said at the start, it should follow its earnings over the medium term. And then the last part of our process is just our stop losses. So obviously not every idea we invest in does double in 5 years. Lots of them do, but some of them don't. And so from our point of view, we need a process to eradicate our mistakes, and that's our stop loss process where we force ourselves to look at any company that's fallen 20% from peak or from cost, and just force ourselves to re-pitch the investment case, to review it. And it creates the picture on the right that I'm showing you. Those are your top 10 winners since inception and your top 10 losers on the left. And so we've never actually lost more than 100 basis points for the fund. So that's 1% of fund returns on one stock, in any stock, in 10 years of running money. And so put that all together. Identify your area of structural growth, identify your winner, identify the qualities of the one that will win within that area, forecast the earnings mathematically, and then be reasonably militant about eradicating your mistakes, and you're effectively mathematically solving for the returns we're generating. There's no luck to it. It's a repeatable process around identifying that earnings growth and then following that earnings growth along the S-curve.
And maybe just to add to that, every single Munro fund follow the exact same process. So if you come into our boardroom and we have one of the stocks up, you can't tell we're talking about a Munro Global Growth stock or a climate stock or small mid-cap stock. It followed the exact same process. And I would say for the smaller funds that we know we tend to be in probably a little bit more volatile areas, that really leaning heavily into the process has been helping us identify the winners and also cutting our losses on some of the stock that we're not going to work out.
And you also mentioned earlier, it's also the same team.
Same team, same process.
Love it. James, you spoke about the growing US power demand dynamic. Can you talk to a name that has worked well in this space?
Sure. Well, there's a few. We showed them in the top winners for the funds for the year to date, or the last 12 months. Maybe just back a couple more, sorry.
Back.
Yeah. Oh, sorry, wrong slide. No, that's okay. I'll just talk to you. I was looking for the 2% power growth slide, if you can find it. Might not, it's in the appendix. All right, couple of winners. On the power demand, okay, so yeah, basically have a think about the last 20 years of the US, right? It's been massively underinvested in because power demand has been flat or even declining because a lot of industries left the US, right? And so fast forward now, a couple of years ago, there's been sort of an aha moment where people realise industry's coming back to the US, data centres are getting built, EVs are hitting the grid, it's putting all this pressure on the grid. Okay, so basically we at Munro look to follow the money and the companies that supply into this grid reinvestment effectively. And so there's a couple of ways you can play it, quote unquote, and we did show them in our top winners. One of them is Constellation Energy, which is a nuclear energy company, i.e. if power demand's coming back to the grid, that asset needs to run harder for longer. That's beneficial as a shareholder of that company because it makes those 20 nuclear power plants that they own today more valuable, and they can charge a higher price for that power that comes out of those plants. In their particular cases, they're signing up deals with tech companies because tech companies are basically short of power to run these new facilities. So they go and contract with a nuclear power company and pay them extra to basically get that power. You can also buy companies that build the grid. As I mentioned, that's a big area of focus. So think about companies that employ guys in hard hats. So obviously utilities build all this sort of stuff, but utilities contract that work out to what's called an EPC company. So we own a couple of them. We own companies like Quanta Services is one that I'd call out there. So, old school sort of companies that maybe get overlooked when you're thinking about climate investments and building out solar and wind. Everyone probably thinks about panels and turbines. You actually need people, tradesmen to go out and actually connect all of this sort of stuff. And then they're going to have a huge runway for growth with batteries as well. So yeah, that's a couple of examples I'll give you.
Thank you.
And sorry for not finding the slide.
No, totally fine. So Nick, does the recent trend towards off-balance sheets and debt funding rather than cash flow funding for AI capex by some of the major players such as Meta cause any concerns?
So the short answer is yes, it does. I mean, there is reasons to to be concerned here, particularly for the companies that don't have the money, if that makes sense. The only thing I would flag is that most of the companies do have the money, okay? And so I showed this picture earlier, and I'm just going to try and get back to it really quickly, but it's going to take me a little while. Is I showed you the hyperscaler capex that's effectively funding this boom. And this boom here, as you can see with this hyperscaling capex, if you look at the companies along the bottom, most of them are funding them out of an existing business. So Meta is funding it out of social, Google's funding it out of search, Amazon's funding it out of e-commerce, Microsoft funds it out of software. Oracle obviously has to go to the market and borrow money. And all of these companies, by the way, are starting to use the private credit industry to borrow money. Again, I think this is fairly normal. And I get it worries people, but I think it is fairly normal. And so again, the best way to think about this is we are building out capacity for an intelligence revolution. We're not building data centers here, we're building AI factories, okay? So no one questions when we build offices that we fund them with debt. No one questions that we have a whole REIT industry that helps fund the build out of offices. No one questions that we have Goodman Group in Australia here that helps funds the build out of warehouses. No one questions that at all because these warehouses around e-commerce are going to be used. Does that make sense? Because the people understand that. The reason why people question this today is because they just don't know what all this data centers capacity is going to be used for. And I would just encourage people to look at the demand side. The demand side is incredibly strong. And so financing vehicles, debt vehicles, different forms of funding are coming to the market to provide this infrastructure. And that is perfectly normal. That's what happens in offices. That's what happens in warehouses. That's what happens with shipping when the whole shipping industry came out. That's what happened in oil and gas when the whole oil and gas industry came out. And so all we're seeing is that happen again. And so I get that it worries people because they can't see where the supply is going to be used, but just look around you at the demand. The demand is everywhere. And I think these people are making a pretty safe bet if they're helping finance some of these things.
And also just the off-balance sheet part, just to sort of put people's mind at ease, the off-balance sheet part generally is less than 1/3 of the total project. So the other 2/3 is actually being flown through the cash flow statement, the income statement, and depreciation is actually pretty clear and transparent to the investors of these companies.
Sounds good. Qiao, I've got another question for you. And we get this question so frequently, I have to ask you.
Yeah.
Is this mid-cap fund ever going to be an ETF?
I mean, look, you never say never, but as of now, look, small mid-cap fund by definition is a capacity constrained fund. And we have been incredibly lucky. We have great distribution partners, and the internal team worked really, really hard. We got to about $450 million of fund size already without having an ETF. So in the near term, we probably don't have the plan of launching an ETF for Munro Smith, but we're on every single wealth platform. We're on Net Wealth, we're on all the private wealth platforms, and then we have contact on the website. If you have, you need help in investing in the fund, just give us a call.
Perfect. So we have a follow-up to the characteristic score. Can you please discuss weighting and importance that you allocate to control / being founder-led?
So the answer is on all 6 characteristic scores, they're equally weighted. So control is one of the 6. But obviously, if a company is more founder-led or management is more aligned, we are more positive that company, so we can pay a slightly higher multiple for it. That would be the short answer, but they are equally weighted. The other thing important to remember is that if you score 100%, and very few companies do, by the way, you're effectively we're prepared to pay double the market multiple for the company. So instead of 20 times earnings, we might pay 40 times earnings, if that makes sense, or some equivalent cash flow measure. And so even some of our best investments like NVIDIA or Amazon, they do not score 100% on our quality score. They score high, but they don't score 100%.
So we are getting very close to the end of the hour. So if you've got any more questions, I encourage you, please, keep sending them through. But like I mentioned, we are getting close to the end. So we'll try and sneak in a few more. We did sort of answer this one already, but it has come up. So you all kind of spoke about the US midterm elections, which will be held in 2026. What are you expecting from Trump and any potential impact on markets?
So I'll make a couple of quick comments. So if anything, this is part of why the US economy should be better next year. So even the signature tariff policy is slowly getting rolled back a bit here, particularly on food items and other things, because Trump is aware there is still an affordability crisis in the United States and he has not solved that. So we expect a lot more consumer-friendly policies next year. and is something that we should be positioned to benefit from, and that's something we in these consumer areas we look at. The only other thing, there is a slight negative side to it that's worth flagging, is that you might actually get some things around power prices, for instance, where they might try and clamp down on power prices and things like that. But you should expect a more consumer and economically friendly policies out of Trump as we lead into the midterms. I don't know if you want to add to that.
No, I was going to actually mention the same one around the power price potential blowback from local politicians and so forth that want to get re-elected, obviously. You could actually argue that could lead to some positives as well, because if you just think about it simplistically, I told you about the Constellation Energy example. So the tech company takes the power off the grid, and the politicians could quite easily say, hey, look, that evil tech company's just basically taken some of your power. Now, that tech company's not stupid, right? Politically, they're going to reinvest in that area, and they're going to create a lot of jobs by building out replacement solar, wind, batteries, etc., to replace that. So it actually could create jobs. So it's not all negative. And at Munro, obviously, we're aware of this. Just like in 2023, we knew there was an election year the next year. We know end of 2025 now, election year next year. We're sort of weighting the fund slightly differently because of this potential power price issue. And as I say, there's potentially some winners out of this as well. So we'll see how that plays out as the year progresses.
So the next question is, should companies building AI factories be depreciating NVIDIA chips over 3 years rather than 6? Surely these chips are being superseded faster by newer chips.
Yeah, it's a good question, and it comes up a lot. What we know today is that people are still renting out chips that are 6 years old. NVIDIA is still selling chips that are 4 years old. And I think, again, I would use the office analogy. Your office building will need to be replenished quite regularly. So we would refit out an office to apply a new tenant, like say every 10 years. They will replenish these chips. I think 6 years is the right number. If anything, it's probably going to be longer than that, because ultimately these chips are still being used today. So the evidence on the ground suggests that these chips are being used much longer and more often than what the depreciation schedule says. And the reason why that's happening is because there's so much excess demand for compute. Just use any chip you can right now because there is so much demand. And so this is why we remain positive. I get the bear case. I think it's misplaced.
Understood. We are getting very close to the end of the hour, and we want to make sure that people get out on time. So Nick, do you think maybe you could just wrap us up? Is there any lasting comments that you want investors to take away?
Yeah, so I'd point investors towards this particular slide here, if that makes sense. And I'm sure there'll be lots more questions on AI next year as well, but we'll move to this particular slide. So this particular slide is something that we show on every monthly and every quarterly. And so for those of you who are watching, I assume you're either investors or thinking about being investors, and please use this as your guiding light. What we're trying to show you here is these are the areas where we see strong structural growth in the year ahead. That structural growth should equal earnings growth. And some of the companies we're showing on the right are the companies that we think will participate in that earnings growth. And that earnings growth will give you share price growth. Our job is to keep these different areas somewhat diversified, if that makes sense. So they should be driven by different idiosyncratic structural growth trends. Look, we get the questions on AI, we have our view. But as I said, it's still only roughly 40% of the fund. Our innovative health ideas will not be correlated to AI ideas. The defense ideas, I showed you Rheinmetall earlier, will not be correlated to our AI ideas. And even our sports companies we didn't talk about that we own Formula One, or Qiao pitch TKO and Son. These are companies that are benefiting from increased value of sports rights and the increasing communities that build around these sports. And so our job here is to find different idiosyncratic areas of structural growth and different winners. As we go into next year, as we talked about, and I think a lot of the questions are good, the economy's probably going to be better. And so we're going to be able to find more areas of structural growth. We talked about consumer a bit here. We can talk about finance as well, innovative finance as well. So we should be able to find more areas of structural growth and ultimately broaden out this fund in the year ahead. We've obviously done very well out of AI. We think we will continue to do well out of AI, but it's definitely not the only thing we're doing here. And I suppose I'd encourage people's view on that. The last thing I'd just say is we got some good questions around process. Remember the last bit about stop loss, okay? As much as we've sat here and told you about what we think is going to happen, the reality is we don't know, okay? We don't know how the next 4 or 5 years are going to evolve. We spend a lot of time talking about it and thinking about it, but we have risk controls in place to deal with the things that could go wrong, like COVID or like wars or all these different things that happen. We've been through them before. I'm sure we'll go through them again. But today it's a very positive message. It's been a positive period. We think it will remain positive. We're excited about the areas we get to invest in. And if anything, we're really excited about what's coming next, because it's a very exciting time to be investing, and one where we're actually all really enjoying our job a lot at the moment.
That's wonderful to hear. On behalf of all of our investors, thank you to the three of you for taking the time to sit down, chat to me, chat to our investors, and answer all of these questions. I definitely want to let you get back to what you guys do best, and that's managing the portfolio. And for everyone who's dialed in, we hope that you found this helpful. As Qiao mentioned, we've got a lot of great resources on our website, so please don't hesitate to head to our website at munropartners.com. Send us an email if you like. But that's it for now, and we thank you all for investing and for your support, and we're wishing you all a very happy and restful rest of 2025.